What if I told you you could save $800 a month on your mortgage payment without having to make a bigger down payment? That sounds too good to be true, right? Well, that's exactly what many builders and sellers are offering through interest rate buydowns. But here's the thing. These offers aren't always what they seem. And by the end of this episode, I'm going to show you the one question most buyers forget to ask that could save them thousands. Hey, everybody, and welcome back to the DIY Homebuyer podcast. I'm Nick, and if you're new here and trying to navigate buying a home without an agent, well, hit the subscribe button right now because you've come to the right place. Every week, we break down the insider secrets and strategies that you need to know to save money and protect yourself when buying a home. And in today's episode, we are diving deep into interest rate buydowns. And be sure to stick around until the end because I'm going to share a negotiation strategy that I recently used to help a consulting client save over $35,000 on their new construction home by turning down the builder's buy down offer. And they used it instead to do something much more valuable. Okay, so today we're going to break down why are sellers and builders offering these incentives, what are the different types of buydowns available, and what are the pros and cons that you need to consider before accepting a buydown offer. So let's start with some context. In the past couple of years, we have seen mortgage rates climb from historic lows around 3% to where we are today, with rates that are in the mid to high 6% range. And this dramatic increase has had a huge impact on affordability and monthly payments. For example, on a $500,000 loan, the difference between a 3% rate and a 6% rate is about $900 per month in principal and interest payments alone. And that's before we even factor in property taxes and insurance. That's significant, and sellers know this. They understand that higher rates are keeping many qualified buyers on the sidelines. So, rather than dropping their prices dramatically, many sellers, and especially builders, are offering to help buyers reduce their interest rates through buydown programs. It's a way to make monthly payments more affordable without having to slash prices. Now, there are two main types of buydowns that you're going to encounter: temporary and permanent. So let's start with temporary buydowns. The most common is called the 2-1 buydown. There's also 3-2-1 buydowns, but the 2-1 is the most common. And here's how it works. In year one, your interest rate is 2% below the market rate. And in year two, it's 1% below the market rate. Then in year three and beyond, you pay the full rate. So if your loan is at let's draw this out. So let's just say that the market rate is 6.5%. Well, with the 2-1 buydown, in year one, you're going to be looking at 4.5%. Year two, you're looking at 5.5%. And years 3 through 30, you're back to a 6.5% rate. So that's about how this plays out right here. This can make a huge, huge difference when it comes to your monthly principal and interest payments. So if we have a $500,000 loan, well, what does that mean? It means that year one on a $500K loan, year one, you're going to be looking at $2,533 per month for your principal and interest. Year two, you're looking at $2,838 per month. And then you get to your market rate in year three, which is the $3,160 per month. So you can see how that breaks down right here, where that first year of savings is massive, right? Like you're looking at over $600 a month in savings for the first year alone, which is huge for most people. Now, remember, these are just your principal and interest payments, so you'll also need to factor in property taxes and insurance, which can add several $100s a month to your monthly payment. But the idea is that your income will hopefully increase over these first 2 years, which means that when your full payment, that 3160, actually kicks in, you'll hopefully be in a better spot financially where you can manage it. Or hopefully, in that 3 year period, interest rates come down so that they're not at the 6.5 anymore, and you could refinance into a different loan at a better interest rate. So that's temporary, like a 2-1 buy down. Now let's talk about permanent buy downs. This is where you or the seller pays points up front to permanently reduce your interest rate. Typically, 1 point costs 1% of your loan amount and reduces your rate by about 0.25%. For example, on that $500,000 loan, paying $5,000, which is 1 point, might reduce your rate from 6.5% to 6.25%, which would save you about $80 per month, but it saves you that $80 a month for the entire life of the loan. So, what should you consider when evaluating these offers? Well, the pros of a temporary buy down is that you have lower payments in the early years when you might need it most. You also have time to adjust to home ownership expenses. You've got the potential for income growth before your full payment kicks in, and these buy downs are typically paid for by the seller. But what are the cons? Well, you can be in for some payment shock when that full rate kicks in. And it might be better to negotiate a price reduction instead, because the temporary interest rate buy down can create a false sense of affordability. I've seen this happen a number of times where people, maybe their income increases a little bit, but at the same time that their income increases, their lifestyle also expands. And so it actually feels like every year their cost of living and house payment is just jumping significantly, and they haven't adequately prepared for that. Now, when we're talking about permanent buy downs, the pros are that you have a lower payment locked in for the life of the loan. And that can be especially valuable if you plan to stay in the home long term. And these incentives are tax deductible if you itemize. The cons are that it's a significant upfront cost. It takes time to break even, and the money might be better used for bigger down payment or home improvements. So, here's what I tell my DIY home buying clients about buy downs. First, you've always got to do the math. You need to calculate what is your break even point. With a permanent buy down, how long will it take for the monthly savings to offset the upfront cost of that buy down? And then, second, you should consider your timeline. How long do you plan to stay in the home? If you might move in 3 to 5 years, well, then a temporary buy down might make a lot more sense than a permanent one. And then finally, number three, think about the opportunity cost. What else could you do with that money? Could you get a better return by investing it somewhere else? All right. So, as promised, let me share how one of my consulting clients turned a builder's buy down offer into massive savings on their new home. So, a few months ago, I was working with this couple, and they were looking at a new construction home that was priced at $725,000. The builder was advertising an attractive 2-1 buy down program. So, on their $580,000 loan, this would have saved them about $825 per month in the first year and $412 a month in the second year, about $14,800 in total savings, which sounds pretty good, right? But here's where the key question I mentioned earlier comes in. We asked the builder, how much does that buy down cost you? Well, it turns out the builder was paying about $23,000 to the lender to buy down the rate. And that's when the light bulb went on. Instead of taking the buy down, we asked the builder to just reduce the purchase price by $23,000. And here's why this was so much better for my clients. The price reduction meant that they needed a smaller loan, which then dropped their down payment requirement by $4,600. Their monthly payment was permanently lower, not just for 2 years, and their property taxes would be based on a lower purchase price. Plus, they avoided the payment shock after year two. All told, when you factor in the reduced down payment, the lower monthly payments over the life of the loan, reduced property taxes, this one move saved them over $35,000 in just their first 5 years of home ownership. So, what's the lesson here? Well, always ask what the buy down costs the seller. Sometimes that money can work harder for you in other ways. So remember, while buy downs can be attractive, they are just one tool in the negotiation toolbox. Sometimes a straight price reduction might serve you better in the long run. Now, if you found this helpful, do me a quick favor and share this episode with someone you know who is looking to buy a home. And don't forget to join our free online community at school.com/DIY homebuyer, where we share more strategies just like this one every week. Thanks for listening, and we'll catch you on the next episode of the DIY Homebuyer Podcast.